Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is March 17th, 2026. We're here with world-renowned econ professor from the University of Virginia, Edwin T. Burton. Professor, welcome.
Good to see you, Hunter. Welcome to you.
A lot going on, Professor. The Federal Reserve meets this week to set the target rate for the federal funds rate. Today, the U.S. Treasury 2-month yields 3.69%. The U.S. 10-year Treasury yields 4.2%. The U.S. is at war with Iran. Professor, what is the effect on our war with Iran on U.S. interest rates, U.S. inflation, and the overall economy?
Well, first of all, let's begin with the Federal Reserve prediction. They will do nothing. They have been fighting to keep repos from pushing through 3 3/4. So if anything, if they weren't successful doing that, you would have had a rate hike, believe it or not. But they were able to keep the federal funds rate within the 3.5, 3 3/4 band. So they will do nothing. They definitely cannot lower it. That's not in the cards. And I suspect Walsh, when he will, I'm sure, make it through Senate confirmation. And once he's Fed chairman, I don't think he's going to have a whole lot of luck getting that rate down either. The debt market is just loaded with debt, not just U.S. Treasury debt, but you've got a lot of debt financing for the data centers and for other things going on. The outlook for rates is not a good one. It doesn't necessarily mean they're going to be flying on the upside, but you're not going to get a lot of relief on the downside. Mortgage rates are now above 6.25. They're in the rough 630, 640 area right now and could go higher, actually. So the rate picture is not a good one. Now, on to Iran. So what's happened there? Now, it's interesting. While oil is the front page item on the war in Iran, oil is not as important as it was in the 1970s to the U.S. economy or even to the global economy. For a host of reasons, the world is now much more a service economy, especially the United States, than it was then. Services don't require a lot of energy generally. Some do, but a lot of them don't. And so oil plays a much less significant role. Plus, we've become much more energy efficient in our use of oil. You can see it in the miles per gallon in the cars that we drive. And you can see alternative energy sources now beginning to be a bigger factor, certainly in Europe, and a bigger factor here in the U.S. So if oil prices, say, go to $120 a barrel, and they briefly touched that last week, but they settled back down into the 100 area. Right now, Brent crude is trading about 102, somewhere in that area. Oil prices up to around 130, while they're not fun, they don't really threaten the U.S. economy in a serious way, and they don't augur for more inflation. That doesn't mean you won't get a CPI number that's a bit higher, but that'll be offset by some lower numbers. The main impact of increase in the price of energy, to the extent there is an increase in the price of energy, is to in effect slow the economy down. It's just like an extra tax on the economy, but there's no reason to expect it to be inflationary. So I think there are a lot of storm clouds for the economy, and I think we've seen them. The employment numbers have weakened pretty dramatically. The GDP number for the fourth quarter got revised down substantially. It's under 1%. The number came in at 0.7, and remember, you have to divide that by 4 to get the actual number because that's an annualized number. So the fourth quarter, the economy barely budged, almost within the margin error of calculating it. So growth has slowed down a lot, and the economy is much weaker, and I think the main impact of higher energy prices is to make the economy continue to move in a weakened direction. So I think the big fear now is the economy gets weaker. I think inflation probably is overblown. Now, that could change depending on what Kevin Walsh does as Fed chair. If he decides he wants to push rates down by a massive expansion in the money supply, well, that could bring inflation back. But hopefully he won't do that. At the moment, it looks like lower inflation as you get into the second half of the year, even though you might see a higher CPI connected with current oil prices. The trend is definitely down for inflation over the course of the year. And the economy is fairly weak. What's interesting about all this is if I told you all those facts, the first thing you would think is the stock market might have trouble. But it's barely had any impact at all since the Iran war started. It has traded down. It's a little bit lower than where it was when the war started, but not much, 1 or 2%. So it's actually a little bit less volatile than it had been before the war started, strangely enough. And while the direction is down, it's down insignificantly. My guess is that won't hold for long. I do think the stocks are probably pretty vulnerable here, although we economists are terrible at predicting what the stock market is likely to do. So take that with a grain of salt. I wouldn't bet on any view I had about the stock market. But I do think the stock market is vulnerable, partly because if you look at the earnings of the S&P, a very big percentage of that is in the so-called Magnificent Seven. The Magnificent Seven, which mainly are the large big tech stocks, which all of you are familiar with, the tech-based stocks have had high earnings, but that's because they're capitalizing all the expenditures on data centers and other things. They're going to have to start expensing some of that right away because there's going to be some depreciation taken on a lot of that, but there's a real question of whether it shouldn't have all been expensed from the beginning. And if you expense the capital that's being spent by the data center effort on the part of the big seven and others, you're going to find that there isn't that much in the way of earnings. If you correct earnings for the fact that a lot of that should be expensed, earnings aren't growing at all. If anything, they're falling for the S&P. So I think people tout the S&P earnings, and you hear these comments like earnings will be up another 10%, blah, blah, blah. Well, yeah, but if you listen to what these firms are saying, if you listen to Google and if you listen to Apple and other people and you ask them, why are you spending $100 billion, what is their answer? Well, we have to do that to stay competitive. What? You mean, well, what's the new product? Well, we have to do that to maintain the products that we have. That's what they're saying.
So are you saying they should expense all the investments they're making rather than capitalize?
Sure. If you're in a business and you have to spend a whole lot of money just to keep the business going, that's not a capital item. That's an expense item. It's a cost of doing business, and it should be expensed. And so their cash flow has certainly been devastated. That's why they're all now, or a lot of them, are headed to the debt market. These companies used to have the best cash flow in the country, but not anymore, because you take a company like Meta in the first quarter last year, they've spent more money on capital expenditures than they had in income. So the net cash flow actually turned negative. So these things you have to think about what these capital expenditures are. Are they producing a new product that they can monetize? Well, I'm sure there'll be some new products. I'm not sure they're the ones that are going to monetize it, though. And if you think about it, we all use these AI products. I pay $200 a year for ChatGPT and $200 a year for Claude Code myself, but suppose I didn't want to do that. If I didn't use ChatGPT at all, I'd be perfectly happy to use Perplexity or Gemini or DeepSeek or Grok. I should list there are 47 free chat products out there. And they're going to be a lot more, and they're going to be free. If they charge for them out of the box, nobody will use them. People just want to use free ones to start and see what they're like. And I know for a lot of purposes, when I use something like ChatGPT, I know I personally ask it questions like, what's the best kind of power bank to carry on an airplane when you're trying to charge vehicles? Well, you don't need to pay $200 a year to get that question answered on ChatGPT. You can have the free version of ChatGPT, or you can ask it to Grok or somebody else. So given that so many of these products are competitive and they're free and everything else, it's not like you have a moat around this. So when you go spend $100 billion, you might just be making your product all of a sudden competitive with somebody else's product. Keep in mind, OpenAI is losing money. They lost $80 billion last year. So, yes, they may have some kind of future, but they don't have any present, really. And they've got to start showing some products that really generate some revenue. Their revenue is growing, but not as fast as their expenses. That's why they're going to the market. Everybody's going to the market to get more money. Why are they doing that? Because they're running out of money. They don't have enough cash flow, and some of these companies don't even have any cash flow. Certainly OpenAI doesn't have any cash flow, and it's not going to have cash flow as far as the eye can see. So what is a company worth that doesn't produce any real cash flow? Yeah, the products are great, but that's not the question of value. Product can be great, and you still might not make money out of it. That's the harsh reality. And particularly when you got a lot of competitors. It's not like OpenAI's out there by themselves. It's not like Perplexity's out there by itself or Anthropic's out there by itself. There are a lot of these products, and they're charging nothing. And I'm not sure I'd be dying to be the top player in a business that charges nothing for its product. And I'm spending hundreds of billions of dollars to dominate that market. Now, I've probably overstated the case, but I think these stocks are vulnerable, and I think the entire market is vulnerable, and I think, to be honest, I think the economy is vulnerable. I think you're going to have an economic slowdown, and that's going to spill over into all these other areas.
Professor, why, given the faltering stock market, the GDP growth virtually zero, in the past, rates fall when that happens? Rates are not falling. What's going on?
Well, the stock market hasn't really fallen. You say the faltering stock market, it's still maybe, down 2% on the entire year.
A couple weeks down there.
No, to get rates really to weaken, you need a major drop in the stock market and a major weakness in the economy. If you see that, then you'll have an offsetting force to hold rates, keep rates from going higher. Who wins that battle, I don't know. As the economy weakens, that'll be pressure on rates to go down. But the deficit's going to grow. The deficit grows when you have a recession because revenues fall faster than expenses. So you're going to have more debt piling into the Treasury auctions. And it's awfully big. There's no indication there's going to be any slowdown on that. If you look out as far as the eye can see, there's no slowing it. The debt is beginning to grow exponentially, and there's no political movement afoot, no political party in the U.S. that has any ideas or plans to stop that from happening. You've got Republicans saying they're going to grow out of it, which they won't. And you've got Democrats thinking they can tax rich people and that'll solve the problem. No, that'll just have all the rich people move to Switzerland. And most of the big companies will move out too. Ultimately, if you tax wealth, wealth will find another place to live. So that's not the answer either. The answer is to get some kind of control over your spending. The spending is completely out of control, and especially in the healthcare area. Healthcare is an area that needs major reform.
Can we afford the war with Iran if we're $40 trillion in debt?
We can afford a 3-week war with Iran. Question is, how long can we afford it? And the president, not to get off into politics, but he's running into trouble. The entire Democratic Party is against the war, and half the Republican Party seems to be against it as well. That's not showing up in the Congress. There's the majority of the Republicans are supporting the president, but some of them, if you talk to them privately, will tell you, yes, I'll vote for this, but I'm not really for it. I wish we weren't doing it. You hear that from a lot of Republicans. And you see recently one of his key figures in the intelligence area just resigned over the issue of the war, and he's in the administration. Now, I say that, I think the president's probably on balance doing the right thing. I don't want to be critical of the president, but politically he's in trouble with this. I'm in the minority. I think the majority of Americans do not support this war, and he's got a limited lifespan to pursue it.
Federal Reserve meets this week to set the federal funds target rate. The current U.S. Treasury yield on the 2-month is 3.69%. If that yield were 4%, would the Federal Reserve have to raise the Fed funds target rate?
They would have probably already raised it, even in between periods. Yeah, they have no choice. They have to move the target range to where the market is. Now, you could argue, well, Professor Burton, you're suggesting that the Fed is powerless to set rates. No, they're not powerless. They can enter the market, and if they want rates to go lower, they can just buy the heck out of Treasury bills and do reverse repos until they get that rate down. But that means a huge increase in the money supply, which will be inflationary. They can go the other way as well if they want rates to go higher. But at the moment, it looks like Federal Reserve people want rates to go lower, and Walsh especially is going to want them to go lower when he comes in. But I don't think he's going to get accommodated. The only way he can get rates lower is by printing a lot of money and buying T-bills and doing reverse repos. And if he does all that, you're going to have inflation down the road, which ultimately means higher rates later. You might get lower rates for a while, but you get higher rates later. So I think they're in a quandary. I think there's too much debt out there at every level, at the federal level, at the business level. And, there's some problems that I haven't even mentioned here. We haven't talked about what's going on in private equity, private credit. These areas are now beginning to dominate the news cycle. You can't pick up a Wall Street Journal or Financial Times or anything else without reading a major story on private credit and on private equity. And you see it in the endowments. You've got Princeton reporting that they're going to have to cut staff and eliminate departments because they can't make any money on their endowment. It's interesting. They're in the biggest bull market in history. The average stock's been up over 20% a year. The last 3 years, and Princeton's reported 4% a year earnings when the average stock is up 20% each year. And a lot of that is because so much money has been poured into these private markets. And the private markets are struggling. There's no way out of that. They are struggling, private credit especially. I do think that these private credit funds mostly have good debt, and if they didn't have redemptions, they really wouldn't have a problem. But what's happening is they got sold to retail investors, and the man on the street, when he puts his money into a private credit fund, he doesn't realize he can't get it out. He assumes it's like going in and getting a CD cashed out maybe early or something with a small penalty, because that's what happens if you close out a CD early. That's what he's used to. He's not used to somebody saying, oh, no, you can't get your money out. And like Blue Owl, for example, Blue Owl may have perfectly good debt underneath the hood, but it's like a run on the bank. You can be a great bank, but if everybody comes in and takes all their money out, you're going to end up being forced to liquidate some of the assets at a discount. And that's the problem for Blue Owl. Their debt may be great, but if they have to come up with the cash in the next 20 minutes, they're going to have to sell it at a discount. So it's really more a classic run on the bank. It's people that want their money back. And so you have in the contract that you don't have to give it to them. You can throw up a 5% gate, which means only 5% of the people can take their money out at any one time. And you can feel good about that. You can say, oh, well, that's what the rules are. But that poor retail investor who bought that, he didn't really understand that rule, and that's what we're finding out. They're coming in large numbers to get redemptions, to get their money out of it. And you know they'll do that if they're having other issues, if unemployment's growing or something, if they lost their job, they're going to want their money back. So what you have is not that Blue Owl made a lot of bad investments. I don't think there's any evidence for that. It's that they didn't expect to have to give redemptions. They thought, hey, this is a fund, we advertised it right. But not everybody sells it the way you write it up in the prospectus. And I think a lot of retail investors ended up buying it. I think it's a mistake to pour retail investors in private equity or private credit. These are not the kind of investment vehicles they're used to. They're used to the Vanguards or the money market funds or something like that where they can get to their money. They're not used to something that's got a 4 or 7 year hold on their money. That's just not the way they're used to investing. So I think it's more that. It's more they want their money out, and in order to give them their money, you have to sell this stuff at a discount. It may be perfectly good paper. That doesn't mean you can get full value for it if you have to sell it in the next 20 minutes. And that's the problem. And that's, I think, what Blue Owl ran into. They decided to give higher redemptions. Now, I'll tell you why that's a business problem. If you're in the business like Blackstone of offering these private credit funds, then having one credit fund is not what you're trying to do. What you want to do is have one credit fund after another. And the last thing you want to do is be a headline in the financial news that you're not letting people out who want to redeem their positions in your fund. So the big problem for Blackstone, the reason their stock got hit so bad, is that this means it's going to be very hard just for them to sell new funds. That's the problem. Same thing with Blue Owl, same thing with all of them. Blue Owl's a little more suspicious because they sold a fair amount of it to their own insurance company of their debt. That was a suspicious move. But generally, anybody that has sponsored one of these private credit funds, what they want to do is a whole lot of them. You don't want to just do one. You want to do one, another one, and another one. And if you're in the headlines where all your investors are saying, hey, I want out, and these turkeys won't let me out, they may be legally okay. They don't have to let them out. But the headlines don't look good for you. You're going to have trouble selling that next fund. And private equity's problem is the continuation funds. Private equity had trouble unloading, particularly these software companies they invested in a few years back. And so they set up continuation funds. So if you're one of their investors, you got to move the asset to the next fund. And sometimes they even took their carry out of the deal. And now they're in a pickle. They've got all these funds, all these investments that they're now having to finance at much higher interest rates than when they first bought into these investments. And that's causing a lot of anxiety among institutional investors, especially you see it among university endowments, you see it among foundations, you see it among pension funds. So we weren't really talking about that, but that's another storm cloud that's hiding. It's really, it's an interesting question. Why, if the public stock markets have been so good, there's trouble in private equity land? Because after all, they're just company ownerships. And I think part of the problem is that when you buy public equities, often you buy a pretty diversified portfolio. But private equity investments by a private equity firm tend to be concentrated in a particular area. And they all get attracted to the same area at once. You know how investment goes. So all the venture capitalists get all excited in Silicon Valley about one thing, AI or software companies, whatever it happens to be. So they all get in that one area. If that area sours, now they all got all these investments in one place. So it's very difficult for them to get out of that. So I think there are a lot of storm clouds. I think the future does not look good for the stock market, at least for a while. I think so far nothing's happened. I'm not saying the market has fallen because it hasn't. It's been a very quiet market. There's been almost no reaction to Iran. So my prediction is what may happen down the road, but I think the economy could get weaker, and I think the stock market could have trouble. Now, I have to warn anybody listening to this podcast that I have a tendency to be bearish anyway. So if you listened to me talk over the years, I've predicted more than my share of bear markets that never occurred. So don't rush out and sell everything you own, because had you done that when I made this prediction in the past, you wouldn't like it very much. But I do think things look weak. I think the economy looks like it's in trouble. I even think the president's in some political trouble, and there'll be political battling that goes on for quite a while. I think the Republicans will probably lose the House when the elections occur in November. That's going to cause some desire to go through the impeachment game again, and I think things become politically very messy as we get on, and that'll affect the economy and the ability to deal with a lot of these things. So I hate to be the purveyor of gloom and doom, but I think it does look a little gloomy out there.
The world is unsettled, no doubt. More to come, Professor. Thank you.
Thank you, Hunter.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.